Hey everyone, my name's Andy. I'm from the Finding Value Finance channel. I'll be your host today. We've got Nick from All Things Ventured from Twitter. I'll just throw up his webpage here real quick so everybody can see if you'd like to add him. It's at all ventured if you want to add him, but that's his Twitter page. We got him on here to talk about a variety of things investment related. Obviously, we'll cover the dry bulk and tankers and all that stuff throughout the interview here. So, Nick, first off, thanks for coming on. I really appreciate it.
Yep.
Being on here. This is the second time he's been on here. So, if you want to see the first portion of it, definitely search on the channel for it. Where do you see value in the market today? Where do you see value?
So it seems like the past couple of weeks we've been getting a huge rotation back to value, just in general, as far as commodities, energy, shipping, is starting to get a bid and starting to kind of disconnect with the broader markets, which is definitely encouraging. And it's how, I've been positioned all year, which, January we had those two sectors kind of like disconnect from the broader market and really outperform. And then we kind of market performed for a while during the middle of the year. And now we've had 2 solid weeks of outperformance again. And so I'm hoping that we've got further to run here in shipping and energy. Specifically, tankers have just been on an absolute tear, and I really don't see that freight train stopping anytime soon. Definitely some concerns coming down the pipe on if Biden stops the strategic petroleum reserves releases, what that could do to the tanker market. But ultimately, there's a ton of other positive tailwinds that are waiting in the wings that could completely offset any loss of exports from the SPR releases. So right now, still very bullish tankers. There's a cigar butt that could be bought in dry bulk right now, which has really been an underperformer. I think on the energy side, it's just a momentum play right now, up and to the right.
Mm-hmm. Yeah, so you're thinking tankers, dry bulk shipping, and energy like coal, natural gas, oil, like those types of investments. Those are the sectors you like.
Yep, that's how I'm positioned. Those are the things that I see performing the best. Here in the interim term. Yeah.
Now here's another question. When you go and you pick the value out of the market, are you basically picking this through the fundamentals? Are you looking at technical charts? Are you doing a little bit of everything? Tell me a little bit about your approach and finding value in the markets and how you're picking some of these companies.
Yeah, that's a great question. So I do it all. And you see a lot of debate over, you see people that are like, oh, technical analysis, that's like horoscopes, and that's, magic this, magic that. And then you see people that will tell you it's all about price action, and I don't even look at fundamentals. And I think if you're not looking at both, you're doing yourself a huge disservice. So for me, I build everything off of a fundamental base. I try and understand the industry. I try and understand, the companies within the industry, what their valuation looks like relative to their peers, and try and build a mental model for what is the worst case scenario that could happen with their upcoming earnings. How is the market going to view it a year from now? And I build that base. And then from the base of, okay, I think I've identified things that, when from a fundamental basis, when I look at this in a year, this thing has to be priced higher. Then I look very closely at the chart and I try and pick my entries, because just because this thing has to be higher in a year does not mean it can't be a lot lower in a month. And, so I think that people are doing them a serious disservice, not trying to learn some technical analysis and trying to pick their entries. And, frankly, being prepared to take, if your thesis plays out and you get to your target price earlier, you got to be able to take some profits on that. So I do a lot of both.
So your approach is you look at the fundamentals first, find your sectors, dive in, look at the technical charts, get your entry point nailed down.
Yep.
What happens if you don't nail the entry point? Do you see, like, if you see a 50, 20, 30, 40, 50% decline? Because some of these stocks are highly volatile. I mean, they rip it both directions. Do you stay with the trade? Do you have stop losses? Do you get stopped out? Kind of what's your approach there?
Yeah. So I personally don't use any stop losses. I have the fortunate enough that this is my day job. So I'm on looking at the markets most of the day. If something goes against me, I'm really there to look at it and have a manual stop in place, and I will sell things if something's going against me and I really just don't know why, or I can really be real about, okay, something with the premise, with the thesis has changed. I will sell a position, and sometimes you really need to bring yourself up out of position to be able to think about it clearly again. And in the past month, I've had a couple instances where I've kind of gotten spooked out of position, and generally, like, I'm not a day trader. I'm buying things with the plan to really hold them for some time, but I will sell them if the thesis changes. And I had one instance where I sold something when the market was kind of dumping, and I just had to come up and reevaluate, and I decided that, you know what, that was the wrong move, and I bought it right back. And but most of the time, I think you'll find that when you take a loss, you're going to realize immediately that that was the right thing to do. And you're going to feel relieved, and you're going to realize, you know what, that was the right thing to do, and there's better places to put my money, or it's better to wait and see. And nothing's preventing you from buying it back. If you come out, take your money into cash, and you go like, okay, no, that was the wrong decision, back in.
Yeah, the only thing I can think of is the wash sale. If you buy and sell the same security at a loss, at least.
Right. And that's the other thing that I will say, besides fundamental analysis, technical analysis, I don't put on any trade without thinking about my tax implications, and that's a whole subject for another time. But this is something that if your holding period could potentially be into the next year, if you're not just trading, swing trading week to week, everybody should be thinking about the tax implications of both taking losses and of not selling your winners, right? And for me, that being able to take a loss for tax reasons makes taking that loss far easier, because you're basically getting paid to take that loss, right, in tax savings.
Yeah, definitely. So I've got a lot of questions on, well, maybe not a lot of questions, but there's some questions that people were asking me to ask you about dry bulk shipping.
Yep.
Like, where we are in this big picture, or at least where you see that we are in this big picture in the super cycle, if there is a super cycle.
Yep.
Are we early, middle, late? Kind of where are we at, and why are we there in that cycle?
Yeah. So I think we're still early in the broader cycle, and the broader cycle really, when you look at shipping cycles, each sector has its own little mini cycle. And you'll notice that when you look at the decades long cycles, shipping as a whole, all segments tend to move together, and they move together because of shipbuilding capacity and investment. And generally, when there's a lack of investment for one sector, it tends to plague the other sectors. And when there's a lack of shipbuilding capacity, it affects all the sectors. So right now, you're seeing really insufficient shipbuilding capacity in the middle and late part of the decade. So from that standpoint, when we really, really zoom out, dry bulk shipping is still early in the larger cycle. Now, we've just had kind of a little mini cycle where we had some boom rates. Really last fall, rates peaked out. And, when the dust settles, it becomes a lot clearer on why we had such a huge boom in rates last fall. And a lot of that had to do with congestion in China, where ships were being forced to wait for longer for crew to test, crew to change, quarantining. Ships were doing some funky routes in order to pick up crew or to meet quarantining requirements before arriving at another port. And that created a massive supply shortage. And we had this huge spike in rates around this time last year. So here we are back in the high season for dry bulk again. And we have had some volumes fall off this year due to China zero COVID policy, due to China's property market really slowing down. But the loss of volumes this year has been relatively small. I think, when we look at the biggest commodity shipped in dry bulk, which is iron ore, I think we're only off like 2% this year. Generally, that grows just about every year. So it is an odd year to have that be down, but it makes sense for where we're at with China, right? So, but that in itself doesn't explain how much lower the rates are this season than they were this time last year. And when we really look at it, that can be explained by the congestion issue resolving itself in China. Now, the supply side hasn't changed much. I think something like 2% more capacity delivered in dry bulk this year. Okay. That's nothing on a historical basis. That's very, very low on a sector that generally volumes grow more than 2% a year. Okay. Going forward, I think the dry bulk order book stands at something like 7%. And when these ships have a 20 to 25 year lifespan, 7% is barely keeping up with replacing obsolescence. So you're looking forward at, you have very limited supply growth into shipbuilding capacity that is constrained, and most of the capacity is booked up through 2025 for especially the larger sizes. Now, the thing that everybody needs to be aware of with dry bulk when looking at and comparing at other shipping sectors is that dry bulk ships tend to be the smallest and simplest ships to build. Okay. So when you're looking at like the second biggest dry bulk ship class, which is Panamax. Okay. That ship, a Panamax sized dry bulk ship, which is, kind of the workhorse of dry bulk, is a smaller ship than your smallest crude oil tanker. Okay. So when it comes down to being able to build these things on a shorter timeline, often out of all the shipping sectors, there's some open capacity in China to build these things. And I think that we have seen that with the dry bulk order book turning a little bit up, but 7% is still nothing. And really, we're looking out till 2025 for any serious volume. So that's the long way around answering your question. I think we're still early in the cycle.
Well, so we've got the dry bulk ships. We know roughly that we can build them and maybe how long it takes. What's the average age of some of these, dry bulk shipping, like the dry bulk ships?
Yeah. Before they get scrapped.
Yeah. So it's 20 or 25 years, but
yeah.
What's the average age out there right now?
Oh, out there right now. Yeah.
Yep.
So average age right now has been creeping up for years. And I think we're at like 13 years almost, the average age of a ship. And figure, lifetime for the largest ships, which is Capesize, has been running. These things have been getting scrapped at like 20 to 22 years. The smaller ships, Panamax and down, average scrapping age is something more like 25 years. But we have new environmental regulations that are coming into effect in January that is going to make these things definitely less economical to keep outrunning. They're going to get scored based on their fuel efficiency. And, 20-year-old ship is 30% less fuel efficient than a modern ship. And if these things are not efficient, they're getting these letter grades that are, saying if you're a C or worse, you're having to come up with a plan to improve your fuel efficiency, which can be done with, different things, but you got to dry dock your ship. You got to put in millions of dollars of investment. So these ships in the interim, they got to slow down. They're not going to be wanted by the world's top charterers. and they're going to be just uneconomic to run. So I'm foreseeing that a lot of these ships are going to start to get scrapped earlier than we've seen in the past. So, what used to be Panamax ships getting scrapped at 25 years, it might be at 23 years. It might be at 20 years. And that's going to start taking supply out of the picture a lot faster than it has in the past.
And I don't know if you know this question or not, and I'm just going to fire it away and you can either say yes or no. Do you know, so we know okay, number one, do we know the shipyard capacity to build X amount of ships per year? And do we know how many ships are coming off or being retired during that same kind of 5-year, 6-year, 7-year time frame? Like, what's that ratio of ships being retired to ships being built?
Yeah, so as far as the ships being built, that's pretty much set in stone. We have excellent visibility to what's delivering when. The ships being retired is a function of economics. There's a point where rates are so high that not a single ship will be taken. I mean, only the ships that are just cannot run anymore because they were damaged or, the engine blew up or whatever else. There's a point where rates are so high that nothing gets scrapped. So, there's an embedded rate assumption there, but at historical long run rates, you're going to see about 1.5% to 2% of the fleet get retired every year under normal rate circumstances. Okay. And because of that, it kind of provides a floor on rates. In the past 2 years where we've had extremely high dry bulk rates, the rate of scrapping has been lower than normal because it's the rate environment has been so high that it's paid for people to keep repairing the ship and keeping it out trading. So we already have somewhat of an embedded rate floor in place where if rates drop too low, you're going to start to see ships getting scrapped again. And that's exactly what's been happening in this past quarter. We've seen 3 or 4 Capesize ships go to the breakers to be scrapped. And that's despite profitable rates still for Capesize. But there's only so long that you can defer this, even in a high rate environment.
So here's another kind of question. And I always talk about market conditions. Market conditions are the conditions that price assets. When I look at dry bulk and I look at the conditions, what would be the ripe conditions for like the biggest bull market to ever occur? And what are some conditions that we want to watch for where this thing could go in the opposite direction and be a complete dud? So for instance, I'll just give you an example real quick. Water's worth nothing when you're sitting next to a facility, a water facility. You can drink water all day for free. You're in the middle of a desert and you'll pay anything for that water. And so when I think of dry bulk, and this is in my head, I'm not an expert in dry bulk. I would think that when everybody wants to ship commodities and the choke point is the shipping capacity, that's when rates just go ballistic. Or if there's a precursor where we have high rates that for a long time. And then they have to scrap all these ships because they've been running them basically till they're all done. And then we also have that pressure of a commodity boom right behind it. What can you describe to me, like what would be the ideal conditions for the market, and then versus, what we need to look out for as investors?
For sure. So aside from the Panama Suez Canal imploding, which I do not wish on for the world, but if that ever happens, if something happens where either of those canals get closed, sell your portfolio, buy shipping, because rates are going to go parabolic. So aside from some kind of shock like that, the conditions that you really want to see for dry bulk shipping to explode is you want to see China step in and pump a bunch of money in to stimulate their economy. You want to see them go right back to cranking out as much real estate as they already ever have, right? You want to see them investing more money into Belt and Road, because that's going to be the main driver of dry bulk, is going to be huge infrastructure spending in Asia specifically. Okay, because a lot of this trade is all about the big resources being iron ore moving from Brazil, Australia, to Asia, and other resources like coal moving from Australia, from Colombia, South Africa over into Asia is really the big driver. So you want China stimulating, you want them to be shutting down the COVID zero policy. And you want, and really, you want all governments around the world to be spending on infrastructure, which we do have a little bit, with this whole green energy spending infrastructure program. I mean, it's going to take a ton of steel, a ton of aluminum to build out all of the cars, all of the windmills, all of the solar panels needed. And that means a ton of dry bulk shipping. So it's going to take some time for those infrastructure packages to ramp up, but that's definitely a tailwind.
And what about the opposite scenario? What do we want to look out for? Is it the actual like shutting down and lockdowns and all that is like the worst case, or is there something worse than that?
I would see a possible worst case, which is very real possibility right now, is that China decides to have some kind of action with Taiwan, but it's got to be more than that. It's got to be we get into a military conflict with China, and the West sanctions China and says, Brazil, you cannot ship ore to China. Australia, you cannot ship iron ore to China. In either of those instances where we really do not allow iron ore to be shipped from Brazil and Australia to China, these boats floating on the water are pretty much worthless.
So that's the demand side. Is there anything supply side that we can look at? It's like from a boat perspective, is there a lot coming into scrap and then we have constraints in building or something on the lines of that?
Yeah, so the other potential huge boon to shipping that's kind of brewing right now is the current environmental regulations that are going into effect. They're honestly pretty weak, and there's not a lot of enforcement. But you've got the EU is going to incorporate shipping into its emissions trading scheme, and not only that, they're pushing for the International Maritime Organization to have stronger policies in regards to carbon emissions. If we were to see some really strong policies, such as a carbon price put on shipping that's high, you're going to see the fleet slow down a lot. So there's a lot of debate about what the current regulations are going to do as far as slowing down, and it will slow the fleet some, but it's relatively minor relative to what could be done and what I think a lot of the environmental groups would like to see done with shipping. So there's this potential hanging out there that from a supply side, the green movement can really slow down the world fleet, which hugely reduces supply and would cause rates to go up meaningfully. As far as the shipbuilding side, there's a possibility that and honestly, I think we're seeing a little bit of it, that because of zero COVID in China and because of all the supply chain chaos, I think that the shipbuilders are a little bit behind on their backlog. And so what you see on paper, that when ships are going to deliver, I think these ships are going to start to get pushed off into further years as far as the delivery dates. Honestly, I don't see that moving the needle a ton, but I also don't see the possibility of adding a lot of shipbuilding capacity in the near term. It just doesn't make sense for the shipbuilders. They're still struggling to maintain profitability. There's still a lot of uncertainty with them around material cost, around labor, and around what is going to happen in the future with, the whole world's telling us that we're not going to need oil and we're not going to need coal. And that's a lot of the world's shipping demand. So until we can reconcile that, I don't foresee shipbuilders adding any capacity.
And then looking at last bull market, like the 2000 to 2008 in that time frame. I know it's maybe I'm a little early with 2000, but During that time frame, can you describe the conditions that happened where rates went vertical like that?
Yeah.
And do you see similar conditions coming up ahead of us that are like that?
Yeah. So when rates last went vertical across shipping segments, it was shortly after China was admitted to the WTO, which I think was 2002. And then they just went vertical into 2008, 2009, when we had the global financial crisis. So that was 100% a demand driven story. I mean, demand came out of China so fast that the world could not keep up on supply. There was not nearly enough shipbuilding capacity to make the ships to carry the trade that was needed by China, starting to trade with the world. So during that time period, I think you saw, the number of active shipyards go from something like 200 to 600, or some kind of like threefold increase in the number of active shipyards. But at the time, our ships that were trading in the global fleet were much smaller ships. They were much simpler ships, and fast forward to today, ships are much, much larger. They're much, much more sophisticated to meet fuel efficiency requirements, to meet just general quality requirements. And so you've seen a lot of consolidation within the shipyards. Only the biggest and most technically advanced shipyards are still existing right now. And today's story is the complete opposite of the last boom cycle story, which was a demand-driven story. Today's story is a supply-driven story where we have had massive lack of investment. Demand's going to just keep, steady Eddie. It generally grows about with GDP. And so demand's going to start just going to keep growing every year a little bit up with GDP. But just like we've seen in oil and other base energy, there's been massive underinvestment in shipping. There's a supply constraint on the shipbuilding. And so it's going to be hard for the world to put enough ships on the water just to meet the kind of pedestrian demand growth that the world is expecting.
Okay. And then here's another question I have, because I'm not maybe as well versed as others in dry bulk.
Yep.
We're obviously playing the margins of dry bulk shipping companies. That's what makes them money. It's their margins.
Yep.
Is there something from their input costs that could impact the profitability of these ships that maybe people are looking at or not looking at that you think is highly important? For instance, if we have energy or oil go through the, to the moon, or diesel or something like that, if there's diesel shortages, would there be an impact to the ships and their profitability or their ability to even run and function?
Yeah, no, it's a great question. So, when you look at the cost of operating a ship, a lot of it is fuel. And contrary to, first order thinking, which is, okay, you're putting more fuel into the ship, it costs more to operate. Really, there's a very strong correlation between higher oil prices and actually higher shipping rates. And the reason for that is because as oil prices go up, ships slow down to achieve greater fuel efficiency. And when ships slow down, it constrains the supply, which then creates higher rates for what limited supply is out there, so long as supply is already tight. If there's already a huge surplus of ships out there, the elasticity of the ships that are out there, generally more of the cost of the oil is going to get, or the fuel, I should say, is going to get borne by the ship owner rather than passed along to the charterer, right? So as far as the cost side goes, an environment with high oil prices and therefore high bunker prices for the ships is extremely beneficial to the ship rates. Other things, other expenses for these ships, they're pretty minimal. They're pretty lightly crewed. I'm sure that labor costs are going up, but that's somewhat being offset by technological advances, which allow monitoring remotely and this kind of stuff. So you're having to put fewer people on the ship. But generally, it's fuel and it's your cost of the ship finance costs to own the ship, your dry docking costs to maintain the ship, and these type of things. Those are your biggest expenses.
Yeah, and here's another kind of off the wall question, or just thinking about things. Do you think we're seeing supply chain shortages, we're seeing labor shortages. I think that's going to get pretty tight with some of the materials as well, in terms of the markets fighting for certain materials. Do you think building these ships with supply chain constraints, potential labor shortages too, just the know-how to build these things, do you think that would have an impact on the lead times of getting these new ships on there if they wanted to build more?
Yeah, absolutely. So we saw this huge boom of ordering for container ships, and shortly after that, I was seeing kind of stories saying that there was not enough capacity to manufacture engine crankshafts, of all things, right? And this is a pretty niche business, shipbuilding, that's really now concentrated in 3 locations of the world: Japan, South Korea, China. They build basically all of our merchant ships. And I just don't think that people are growing up wanting to go into shipbuilding anymore. So I think you're going to have a lot of constraints on the labor side. You're going to have a lot of those constraints on the know-how side. You're going to have a lot of constraints on the supply chain side, like you see. And if it's something as simple as we can't get an engine crankshaft to keep up with the order book, who knows what other things are going to be out there. But modern ship building is a lot more technical than it used to be, where in the last boom from 2002 to 2008, we saw all these Chinese shipyards pop up, and they're just welding steel together to make a bathtub that floats. These really crappy ships. That doesn't fly anymore. Nobody wants those ships. So there has to be some level of automation and know-how at these shipbuilders to be able to build a ship that meets today's standards.
Yeah, so the way that I think of it, and I know we've had chip shortages that basically delayed the production of automobiles. I look at these gigantic ships, which are highly, I would think, highly expensive, highly commodity intensive. I'm thinking that they're probably putting a bunch of technology onto it, just like you're saying, with maybe chips and other things that monitor all these different things. And with the skill set that's probably needed to build these brand new ships, and even maybe new ships that people have never built before, with new emissions technologies,
Yep.
with new technology on it, where it requires more chips, more this, more that. I would think that there's a probability where they can't build these things very quickly. It's a long lead time, much longer
Yep.
than what we've seen in the past. So, I'm thinking at dry bulk, like, maybe we get a good commodity drive out of it. We see interest rates going up quite a bit. I'm sure these are being financed to some degree. That may even impact the shipbuilding as well, with the higher interest rates and the financing of it. Do you think there's some way that the supply side really can't respond? It gets stuck somehow. And then you've got the demand side, where let's say we go into an energy crisis or something like that, which I think we're in, and
Yep.
they just say, you know what, we are going to stimulate our economies by hiring everyone we can to build renewable energy, which is very mineral intensive.
Yep.
Do you think there's a situation where we just flood everything with money going towards solar or wind or wherever, and we don't have the shipbuilding capacity to keep up with that demand? Do you think there's that possibility there?
Absolutely. Absolutely. I mean, I think that, especially if the economy worsens from here, and you might see something out of China soon, that in order to avert some kind of economic crisis, they just pump up their economy full of money to pursue, whatever infrastructure, just to do it. And you could see a demand situation, probably not like you saw in the early 2000s, but, if we do get a bunch of money thrown at this problem, and thrown into, what are you going to do? How do you stimulate your economy? You gotta build infrastructure, right? Yeah, you're going to see the demand side take off, into a supply side that just can't handle it, right? and you were asking about being frozen as far as like financing costs and this kind of stuff. We've been there. That's why we're already at historic lows for dry bulk and tankers as a percent of existing fleet. I saw a stat recently that, if you were to buy a new VLCC today, which is the biggest of the tankers, oil tankers, in order to pay for your expected new building costs plus your expected finance costs, you need a rate that's something like $50,000 a day. Who is gonna ante up for and lock themselves into a break even of $50,000 a day when for the past I don't know how many years rates have been lower than that, right? And you're seeing a similar situation in dry bulk. Because costs of shipbuilding have gone up so much, because costs of financing has gone up so much, that break-even rate for a new build ship is at a level that people they don't want to touch right now, especially when you go into the secondhand market and get a secondhand ship that's far cheaper on a straight line depreciation basis than a new building ship, right? And so until you see secondhand values come up to parity with new building prices, I just don't see people ordering many new ships in dry bulk, in tankers. And so, I think you're absolutely right. There's people are kind of deer in the headlights right now with what's going on with commodity prices and with interest rates.
So another question I have. So we're looking at dry bulk. We're looking for companies. We do the fundamental analysis. We do technical analysis. How do we monitor if we're on the right side of things in dry bulk? Do we look at iron ore and the price of iron ore? Do we look at the Baltic Dry Index? What do you look at to monitor what you think would be a good thing to monitor while you're looking at dry bulk?
Yep. So the two things you got to be looking at for sure if you're invested in dry bulk, so you got to be looking at the Baltic Dry Index, which is today's spot rates that are being paid for single shipments of dry freight, right? And then the other thing that you absolutely need to be looking at is freight futures. So just like you're looking at a futures curve for oil or coal or whatever else, there's a market. It's not traded on the CME. It's its own exchange for freight derivatives, for dry freight derivatives. So there's a website that posts this information for free that everybody can look at. It's braymarscreen.com. And then the other place that you can look without even going there, there's an ETF that trades dry freight futures. It's BDRY, BDRY. And that can kind of give you a sense of which direction freight futures are going, as opposed to just your spot price, which is the Baltic Dry Index. So, when you start to see these two things turn up, that's an indication that supply demand balance is getting tighter, right? The other thing to be looking at is definitely be watching iron ore. Same story. Iron ore price is starting to turn up. That's an indication that demand is coming back from China. And when iron ore demand rises, generally your coking coal demand rises with it, because that means that steel demand or steel manufacturing demand is going up. So those are the two big things. On a lesser basis, you'll want to look at what the forecast is for the world's grain production, right? So the biggest grain producers and exporters are really the US and Brazil. And so, kind of being abreast of what's going on with harvest in the US, what's going on with harvest in Brazil. Are we going to have a bumper crop, or, is the crop going to get decimated like, it has been for a couple of years in Brazil? So this year we're hearing, I was just reading an article that we might have a glut of soybeans in Brazil this year, which would be a huge boon to dry bulk shipping, because all of those soybeans all those excess soybeans are probably going to move into excess storage in China. They'll take advantage of lower prices and import a ton of soybeans.
So that's a good thing though, right?
Absolutely. For dry bulk shipping it is. Yeah.
Yep. For dry bulk. Yep. Okay. So, what else should an investor be asking? What questions should we be asking about dry bulk that I haven't asked already? Is there anything where we should be aware of something that I'm not asking?
Yeah. So, in shipping, you should always be asking about corporate governance, about how well shareholders treated. A lot of these companies in shipping are run by closely held Greek families that have ship management companies that are related parties, where they're taking the public company and they're paying themselves related party transaction fees to their ship management company. And not to say that these things can't be bought. I mean, I own some of them, but it's not like other sectors where there's a higher confidence that you can just buy it and management's going to take care of you. Often in shipping, the managements don't have your best interests at heart. Some of them are great, but there are some questionable ones out there. So that's the question you always have to ask.
And they always ask me this, what are a couple companies that someone should look into? If you're looking at dry bulk, what are some of your favorites? I think you had Navios Maritime last time, but
yeah,
what are some of your favorites still?
So right now in dry bulk, I still like Navios Partners. That's my top holding. But as far as pure plays go, Safe Bulkers SB is pretty extraordinarily cheap right now. They've got an active share repurchase. That's a good option. To be seen what happens with Synergy, which is SHIP ship. Also very cheap right now. Capesize rates have been pretty bad, so that's why that one's trading so cheap, but it still trades at like 40% of NAV. So if we see an upturn in the Capesize market, I really like that one. For somebody that wants to just kind of set and forget it, I like Starbulk, which is the biggest pure play dry bulk operator out there. They have a fleet that's 100% scrubbers. I think with our refining kind of crunch that we're going to have right now, doesn't matter what type of environment we get for dry bulk. I think that Starbulk is still going to be profitable just because they're going to be making a ton of money off of the scrubbers that are on their ships. I think that's a pretty good list of some things to look at. You've got the biggest and some smaller options for you.
What other sectors are you looking at outside of dry bulk that you just keep getting drawn into, just in this market right now?
Yeah, definitely tankers, definitely coal. Those are the two biggest for me. These coal valuations are just crazy. I keep asking myself what I'm missing here. Because, companies like Peabody, unless the coal price crashes tomorrow, these companies are looking like they're going to make their entire enterprise values next year. So, I just don't see the coal price crashing until we've got a solution on where we're going to get more base energy supply from. So
you like the coal then? You're on the coal train?
I do. Yeah. So got a big Peabody position. And have been adding on dips. Let's just say that.
Is there anything else that you're looking at that you just keep thinking, you keep migrating, or you keep wandering and looking at, or is it just coal, energy, and shipping?
Yeah. I stayed pretty focused, honestly. There's not a ton of stuff out there that's been pulling me away. Like I try and keep abreast of a lot of what's going out there, what I might want to buy once kind of the regime changes. But for right now, I just personally can't justify buying anything outside of those three sectors. It's outside of my scope of competence, and I just don't think we're there yet. Sometimes I want to buy these kind of growth at a reasonable price type companies that are getting down to 10 times earnings. But, I have to rein myself in and be like, okay, is it time to buy the growth at a reasonable price, 10 times earning company? Or do I buy the thing that's probably going to make its enterprise value next year? And for me, the answer is I buy the thing that's going to make its enterprise value next year.
Yep,
and
I would too.
I'll buy the growth at a reasonable price after I've made what I plan to make on my, one times enterprise value next year type stuff. You got to keep stuff in perspective. Maybe I'm a little bit more stacked towards these sectors than most people should be, but that's what works for me.
Is there anything in the markets that worries you right now, where you're like, man, I get worried about it, keeps you up at night, whatever it is?
Yeah, the one thing that can completely rug pull this whole thesis is China, and so if we have some kind of conflict, it's going to be it could be very ugly for energy. It could be very, very ugly for shipping. And that might be why valuations are what they are on many of these energy and shipping names. So you have to assign your own probability of that risk, and what you believe under that, in that scenario. Personally, I'm a little bit more comfortable with it. I think there is a material risk that we have some kind of conflict with China. But I spent a lot of time in the country. I still think it's a very low probability that we see any kind of action on Taiwan in the next few years. And so for me, I'm a little bit more comfortable, but I think that everybody should do what makes sense for them, because if you think that there is a problem here, shipping and energy, it's risky.
When I always think of war, I always think energy is going to go up, not down.
Yeah, people don't need less energy in a wartime scenario, right? It's just what worries me is what is allowed to be traded. We're seeing right now with the Russian-Ukraine conflict that the Western governments are doing their best to not let this stuff trade. Now, despite their best efforts, Russian oil is still very, very much trading. We have further restrictions going into place in early December. And I still see a lot of commentary both ways on whether that's going to have a meaningful effect. My story the whole year is that Russian oil will ship, because there's lots of historical precedent that even in these sanctions scenarios, markets will find a way to ship this stuff. There's just too much money out there on the line, right? And so I'm still of that opinion. I still think Russian oil will ship, despite whatever Western governments try to do to prevent it from shipping, it's going to ship. So from that standpoint, to answer your question, if we have a conflict with China where Western governments try to sanction China and try and prevent commodities from shipping, I don't know how successful they're going to be, but it's a risk.
Okay.
Yeah.
Well, I don't have any other questions. I don't know if you have anything that you'd like to state for everybody, or anything that you've got that investors should know that you think maybe they should know.
No, it's fun coming on here, just checking back in and talking shipping on where we're at. Yeah, hope to do it again soon.
Yeah, definitely. All right, guys. So that's all I've got. Definitely check out his Twitter. It's @allventured. If you want to, connect with them or ask them some questions. So that's all I've got. Thank you for coming on, Nick. I really appreciate it.
Thanks, Andy.
And we'll catch everyone next time. Thank you.
All right.